I think a lot of life insurance policies are a terrible investment, but there's some serious nuance that needs to be discussed to unravel that statement. So let's talk about it in today's whiteboard video. The first thing I want to discuss when unveiling that statement is structure when we're talking whole life policies. So let's start with our cash value here, and then we have the year of the policy. Let's say we have year 0, 5, 10, and 15. So I would say with most whole life policies that aren't designed in the infinite banking way, they're not going to break even until year 15. And then more importantly, they're not going to have any access to the cash flow up to year 5 and maybe even past that. So that means for years 0 to 5, they're having access to zero cash. It's important to note here that this could work for some people, but this is not the way that I implement the strategy for the majority of my clients. A lot of policies on the infinite banking side are going to have a 70+ efficiency rating. Essentially what that means is of the cash value that they're contributing to, they'll have access to about 70% of that money. They could then take that money, leverage it out, and buy cash flowing assets to pay off the interest that they took from their policy. Another thing to note here is that infinite banking policies are typically going to break even around year 10. And really this is the no later than date that I see for a lot of policies. Honestly, from my line of work, I see policies breaking even around the 5 to 8 year mark. And we could get these results that we see on the left-hand side here because of the specific way that we are designing these whole life policies. We have a higher PUA split that is allowing us to put more premium inside this policy to complete the generational growth cycle that we talked about. The next concept that I want to talk about here is return compared to what? Let's break this down with an example. Let's look at our cash value inside of a whole life policy. Let's say it ends at year 100. The average rate of return that you're going to get inside of a whole life policy is going to be around 3 to 4%. That's looking at the entire life cycle of the policy. But when looking on the security side of things, what's advertised is a return of around 8 to 12%, but that just simply isn't realistic. After looking at taxes and fees, that number is more like 6%. The main takeaway here is we can't look at things in a one-dimensional manner. Just as we're looking at our financial health, we can't just look at net worth while completely neglecting the concept of cash flow. When breaking down the benefits, I really like to look at 3 separate sectors. So at the top, we have protection, and then we have retirement and taxes, and then finally leverage. When we're looking at protection, we have access to a death benefit. That death benefit is going to be passed on to our heirs in a tax-free manner. Another cool concept, and one of the reasons why people love whole life so much, is because if something were to happen to you, like a chronic illness or terminal illness, you could access some of that death benefit early and use it to cover whatever medical expenses that you may incur. The next concept that I like to look at is the retirement and tax advantages. So not only do you get access to your dividends tax-free and penalty-free up until the cost basis, you also don't have to jump through the red tape as you would in a similar account like a Roth IRA. You don't have to jump through that 59.5-year timeline or go through any of the early withdrawal fees that you may encounter in similar accounts. The final concept that I want to talk about is leverage. So to break down this concept of how to use whole life, we're going to go through the generational growth cycle. So we have a person here, and he's going to contribute premiums inside of a whole life policy. Inside of that whole life policy, that's going to contribute to his cash value. He's then going to leverage that cash value to go buy an asset. A great example is a cash flowing piece of real estate. That real estate is then going to generate cash flow, which is going to pay off the interest that he took from the whole life policy. So at the end, the cash flow plus the dividend is going to pay off the interest rate that he took from his whole life policy. And there's also some other cool nuance to talk about here inside of these whole life policy loans. So one of them is time. You get access to these loans quicker without jumping through the red tape that would exist when leveraging a loan with a bank. Next is the structure. So if you were to take a loan from the bank, they would be hounding you on payments. If you miss your payments, there would be certain penalties. But with whole life, that structured timeline does not exist. Inside the infinite banking community, it's definitely advised to pay off that interest, but you have flexibility when you're taking your leverage, which is another reason why people love these policies so much. The last concept I want to talk about here is tying the generational growth cycle to the concept of the Rockefeller Method. So again, the Rockefeller Method is trusts, which hold different holding companies. And inside those holding companies are different assets. Most importantly, at the core is whole life insurance. Let's break down an example of what could happen here. When someone dies in your family chain, that whole life death benefit will be paid out into the trust, and the members can leverage from that trust at a much better rate, or even in the form of a grant, to get to their why quicker. For example, if you're setting this up for your family, you could set a rate of 1 to 4% instead of a bank's 8+%. More importantly, you could set the rules and regulations that control the trust system that you created. I hope you enjoyed today's explainer video. Remember, the end process that we're working towards is essentially becoming your own bank. If you want to learn more about the system and how to start your own bank, reach out to me at Generational Growth Co.